Of course, inflation as a narrative has attracted everybody's attention, with all eyes on inflation and the potential trajectory of it and the implications that this could have for central bank decision making around the world. However, what would you say if I was to tell you there was another component that potentially may have been overlooked but is just as important, particularly feeding into the central bank's decision making process, like the Federal Reserve? Today, we'll unpack all of these key definitions and talk about why inflation expectations matter and what this could mean for things such as the wage price spiral or bringing forward of demand.
Sit back and enjoy.
And so starting us off with a bit of a meme, of course, everybody will remember just 12 to 18 months ago when there was a discussion about inflation. Is it transitory and when will it naturally start to subside? Of course, we now know that inflation is no longer transitory. The Jerome Powell discussion has almost become a meme. But we'll unpack what this actually means and why this type of telegraphing was being provided. But first, I wanted to draw our attention to the University of Michigan inflation expectation numbers. These come out regularly, we get them each month, and they give us an insight into the consumer's 12-month forward expectations, the median expectations of inflation. These have risen quite significantly. We're at the 5% mark here. And actually, the market sold off after the previous reading because it was more elevated than was anticipated. And you might be wondering, well, this is actually well below the current CPI levels of 8% plus that we're seeing across many leading nations, including the United States. Why is this so important and why is it so scary? And a lot of this has to feed into the discussion surrounding the wage price spiral. So the wage price spiral, it's a phrase that you might have heard quite consistently over this past period. It's entering more and more into the broader discussion. It's a macroeconomic theory that describes the cause and effect relationship between rising wages and rising prices. But it's important to understand that it's circular in nature. And so, of course, there's always a catalyst that drives these things. But depending on which part of the circle we commence, either wages start to rise because cost of living becomes too much as cost of living rises because of obviously inflation-driven pressures, then workers will go to their employers and say, I need more money to be able to survive. So obviously, as their wages rise, well then the firms, the companies themselves will have to put their prices up to be able to cope and to be able to maintain their margins and profitability. But of course, as they push their prices up, what happens? Well, that then has an inflationary effect. And obviously, as wages increase, there's then more money that can be spent into the economy, which drives further demand. And of course, that can become inflationary in nature. And so as wages go up, then that can lead to an increase in prices, which can lead to more inflationary pressures, which can drive wages up and higher and higher and higher. But what's important to note about that is this effect has the ability to bring forward purchasing decisions. And so if you anticipate that a TV that you want to buy now, which is $1,000, could be $1,500 in a couple of years, well then most rational people would potentially consider getting it earlier now. But if those types of decisions are amplified thousands or hundreds of thousands of times across the economy, well of course, particularly when supply chains are stretched as they already are, well that can lead to increases in prices as demand rises. The same in terms of investment decisions as well. And so it's not only the discussion about whether inflation is transitory or not, but it's the expectations surrounding that inflation discussion. And that's why central banks are always trying to telegraph and give us as much insight as possible to really give us that forecast about where things are heading, because it's not only about the actual current effects, but it's about the expectations too. And obviously we know that as consumers, we are driven by emotions as well as logic and rationality. And so it's fascinating to really reflect on the fact that inflation expectations matter because prices end up reflecting, in part, what people expect them to be. It can become a self-fulfilling prophecy in a way. The Fed's monetary policy strategy and other central banks around the world needs to address both the causes of the historically high current rates of inflation. Obviously, we know there's a lot of supply side pressure as well as increased demand for a range of reasons, which we've talked about on the channel. But it's also about people's hopes and fears about future prices. And so this starts to feed into why we get the dot plot. This starts to feed into why we get this well-telegraphed discussion about not only where inflation may head, but also interest rates. Because obviously if they have the ability or they're able to show and maintain that credibility that we know how to navigate and combat this elevated inflation and bring it back to the 2 to 3% band that of course they've had as their target range, well then that's going to lead to different types of purchasing decisions than if consumers are scared and they think there's going to be runaway inflation, we can't navigate this soft landing, we can't get that genie back into the bottle. There'll be different purchasing decisions that come as a result of that. And so it's a fascinating time. First and foremost, if you've enjoyed the video, we've just launched this second channel, so make sure you've subscribed and turn your bell notifications on for plenty more macroeconomic discussions. Obviously, we're in an uncertain environment. We're about to get some more insights about how companies have gone passing on the rising cost pressures on both the labour market side as well as the raw material side with this earnings season. Earnings season is honesty season, it's reporting season. We'll start to get some more of those insights there. We're also looking for the supply side pressures to hopefully subside at the back end of this year. And of course, we'll wait to see the effects of the central bank's decisions to raise interest rates. We know that monetary policy is a blunt tool, it operates with a lag, so we're going to have to wait to see. We're looking for signs in the labour market as well about the broader macroeconomic picture. I'd love to know your thoughts. Drop in a comment below. Let us know what you've made of it all. A big thank you for joining us. For now, stay well and happy investing.